let's discuss the technicals of the markets. For now, we have Rahul Sharma, Director, Head Technical and Derivative Research, joining us on the show from JM Financial. Rahul, hi, a very good afternoon to you. What's happening with the markets? Very range bound, not doing much, and if at all, it's actually giving you a tad bit of negative signal. Do you concur, or is it more buying on dips for you?
Yeah, very good afternoon. So the way it is headed, it seems like we are in for a stress test of this entire setup for the third time post the Ukraine-Russia crisis broke out. We did that in September. We tested the 200-day EMA floor test. We did that in early February, and now there's the third time that we're doing that in terms of checking the tolerance of whether buying emerges at these levels or not. I think going by the overall structure, it seems like 17,450, 17,500 is a crucial demand area. And if this level is honored, if this level is not broken on a closing basis today, tomorrow, mind you, this is the monthly closing as well, monthly expiry as well, and we have the weekly closing coming up tomorrow as well. So if these level of 17,500, 17,450 area doesn't get broken on a closing basis, my sense is we should be heading for a bounce back, which can bring us right back into the consolidation zone of 17,800 to 18,000. So my reading is, yes, we've seen a breakdown from 17,800 levels, but if we talk of the derivatives part, we have, until yesterday we were quite oversold, the put call ratio hovering into heavily oversold territory. And today we've seen some green shoots from the lower levels. Even on the daily charts, the bullish divergence is getting built up on the RSI for the Nifty, which indicates that the momentum is not as fierce as what it was when we had this crash in end of January, early February. So my reading is we should be more optimistic than pessimistic at 17,500. The risk rewards are more favorable for fresh long addition at these levels, and one can expect a bounce back of minimum 300 to 400 points from the 17,500 trajectory. And we believe that only if 17,450 is broken on a closing basis will it call for any further shorts or further weakness into the broader market. Bank Nifty, which has been a pain point for the market, seems to have achieved all its downside targets. And now I think the case is right for a bit of a bounce back from these levels. Some green shoots are visible in private banks. In fact, Axis Bank is one of the stock setups that we like in particular. The stock has taken support at its long-term moving average, which is the 200-day moving average, and not broken its yesterday's low in spite of what has happened in Bank Nifty today. So on a relative scale, we believe that there is some sort of green shoots emerging in the private banking space. HDFC Bank is another stock where we feel that on a relative comparison, this stock is outperformed by a big margin as compared to any of the other private banking names. So if you are if you have like a 3 to 4 month kind of a positional view, I think HDFC Bank is the one to go for. If you are a trader, I think Axis Bank suits the bill, and we feel that there is a 5 to 6% kind of a bounce back, which is very much on the cards in Axis Bank.
Okay, so those were the top recommendations coming in. Axis Bank is also something that you're watching out for. But anything from the auto space? Because I think you have a sell recommendation coming in on Ashok Leyland. Talk to us about your rationale.
Yeah, so it's that kind of a market where we are not expecting kind of a runaway rally for sure. There will be pockets of the market which will undergo corrections, and one of them is Ashok Leyland. In fact, the stock has broken its 200-day EMA yesterday. The stock never performed on the upside. It has been a laggard in the auto space, and we believe this fresh breakdown can bring the stock back to its December lows. It tested around 135 in December. I think that low is very much on the cards. So one can look to short Ashok Leyland. It's a trading target. It's a trading target. 135 is the working target that we have for a short term. Can be shorted with a stop loss placed at 145. And we believe that this is one of those counters which, in spite of the overall sector, which is auto being relatively robust, this has seen sort of an underperformance going through. So I think that will now get converted into momentum on the downside, and one can look to short. So we are going with a long and a short approach. On the long side, we believe private banks should see a bounce back from these levels. And on the shorting side, I think Ashok Leyland from the auto pack looks like a good candidate.
Thanks, Rahul, for joining us with that quick take on the technicals of the markets. Of course, it's the monthly options expiry, so expect that volatility.